Pull out your wallet. Imagine it's made of glass. Every bill inside, visible. How much, how it was earned, when it arrived, all of it, exposed. Every month a payslip arrives. The eye goes straight to deductions, income tax, health insurance, national pension. Numbers drain out one after another. They are always precise, never wrong. In 2021, ProPublica obtained classified IRS tax data. Jeff Bezos' effective tax rate was made public, 0.98%, lower than the sales tax on a cup of coffee. This is not tax evasion, it is legal. So who made this law, and why? Today's story is not about how the rich evade taxes. It is about why some money was designed to be caught from the start, and why other money was designed to hide forever. August 2011. Warren Buffett wrote an op-ed in the New York Times. The title read, "Stop Coddling the Super Rich." He disclosed his effective tax rate, 17.4%. Then he disclosed the rate of his secretary, Debbie Bosanek, 35.8%. The third wealthiest person on earth paid less than half the rate of his own secretary. His own words. Buffett did not call it illegal, he called it unfair. And he added one line, "My billionaire friends and I have been coddled long enough by a billionaire-friendly Congress." This is not an exception. This is the system. And inside this system, there are two wallets. One is made of glass, one is made of leather. Taxation only reaches into the wallet it can see. The question shifts, not why do the rich pay less in taxes, but why was the wage earner's money designed to be caught so easily? The answer begins with war. December 1941. Japan attacks Pearl Harbor. America enters the war. Military spending explodes beyond comprehension. The problem was money. At the time, income tax in America was paid only by a tiny slice of high earners. In 1939, the number of actual taxpayers was 3.89 million, less than 3% of the total population. That was nowhere near enough to finance a war. Congress slashed the income tax threshold and drove up the rates. Suddenly, tens of millions of factory workers and office employees became taxpayers. The next problem was the method. At the time, taxation worked on a deferred basis. Last year's income declared and paid the following year. Workers living hand-to-mouth had no way to save up a year's worth of tax. One man saw through the problem first, Beardsley Rummel, CFO of Macy's department store. His solution was simple and ruthless. Take the money before it ever reaches the worker's hand. Before the paycheck is issued, the employer withholds the tax and pays only the remainder. The worker never needs to feel the act of paying. The number left after deduction becomes their income. And so we are taught, not that we pay taxes, but that what remains after tax is simply our salary. June 9, 1943, President Roosevelt signed the bill, the Current Tax Payment Act, the birth of withholding. The results were immediate. 3.89 million taxpayers in 1939, 42.65 million by 1945, more than tenfold in 6 years. The war was the moment your wallet became glass. The war ended, but this system did not. The logic from the state's perspective was clear. Once money started flowing automatically, there was no reason to dismantle the pipeline. No arguments, no audits required. A perfect pipeline connecting corporate payrolls directly to the Treasury. Economists call this fiscal illusion. Because the pain of paying is gone before it's felt, people don't resist taxation. The state collects, without resistance, automatically, permanently. The foundation of most of the world's tax systems today was completed at this moment. But in 1943, the state made the wage earner's wallet glass. What happened to capital income? It was not glass, it was leather. A thought experiment. Two people. A earns 100 million won as a salaried worker. B earns 100 million won through stocks. Same 100 million. How different is the tax? In the United States, the top nominal rate on A's earned income, 43.7%. The rate on B's long-term capital gains, 29.2%. Same 100 million. One is exposed every month. The other can hide until the moment it's realized. And this structure is not unique to America. The UK is similar. Top earned income rate, 45%. Capital gains, 20%. Japan the same. Earned income, 55.9%. Capital gains, 20.3%. In every developed nation, the method differs, but the pattern is the same. Earned income is more transparent. Capital income is more flexible. The exception is Denmark. Denmark taxes capital gains at 42%. Why is capital income taxed at lower rates? Economists cite double taxation, the lock-in effect, and global capital competition. These arguments are not wrong, but there is another force at work, one that doesn't show. In 2022, the Biden administration tried to eliminate the carried interest tax loophole for private equity managers. This performance fee was essentially compensation for labor, but tax law had long classified it as capital gains. Top earned income rate, 37%. Capital gains rate, 20%. Billions of dollars in difference every year. The bill was killed at the last moment when a single senator exercised veto power. That senator's primary donor was the private equity industry. In 2024, more than 13,000 lobbyists were involved in tax issues in the United States. Over 85% of those who hired them were major corporations and capital groups. The money poured into lobbying exceeded $5.5 billion in a single year. Building a leather wallet costs money. Only certain people can afford that cost. Back to the story of A and B. A receives a payslip every month, knows exactly how much tax was taken. No way to escape. B is different. According to data exposed by ProPublica in 2021, over 5 years from 2014 to 2018, America's top 25 billionaires grew their wealth by $401 billion. The federal income tax they paid, $13.6 billion. Average effective tax rate, 3.4%. Bezos grew his wealth by $99 billion. Tax rate, 0.98%. How is this possible? The method is surprisingly simple. Buy, borrow, die. Buy, purchase stock and watch the price rise. But don't sell, because selling creates a tax event. Don't sell and the gains remain unrealized. Tax law does not tax unrealized gains. Borrow. When cash is needed, don't sell stock. Use the stock as collateral and borrow from the bank. The loan is not income, no tax. Stock returns run 7 to 10% annually. Interest rates, 1 to 3%. Assets keep growing. No tax bill arrives. The bank is happy to lend. The collateral is Amazon stock. And die. When a wealthy individual dies, U.S. tax law resets the cost basis to the market value at time of death. A share bought at $1 that becomes $1,000 at death. The heir inherits it as if it was purchased at $1,000 from the start. A lifetime of accumulated capital gains tax vanishes into the air. Not tax evasion. The law was written this way. The fact that it is legal is precisely what matters most. The question is not who gets the exception under the law. It is who gets the benefit of the law. Even Buffett's 17.4% was far lower in reality. When ProPublica calculated actual taxes paid against wealth growth, Buffett's true effective rate was 0.10%. Bezos's 0.98%, within the buy-borrow-die structure, is, in fact, even lower than that. This is the true thickness of the leather wallet. There is a third structure, the asymmetry of access. A has no tools for tax reduction. only the year-end settlement. B has corporations, trusts, offshore holding companies, and armies of tax attorneys. The buy, borrow, die strategy is not available to everyone. It is an infrastructure accessible only to those with assets above a certain threshold. The difference between the glass wallet and the leather wallet is not a difference in income. It is a difference in which tools you can afford to buy. UC Berkeley's Sayez and Zuckman calculated the effective tax rate by income class, combining all taxes. One conclusion: middle class, 25 to 30%. The top 400, 23.8%. For the first time in American history, the effective tax rate of billionaires had fallen below that of the middle class. Put another way, a middle-class family living on $75,000 a year hands 25 to 30% of their glass wallet to the state. A billionaire with hundreds of billions in assets holds a leather wallet and pays 23%. The progressive principle, that higher income should mean higher rates, has been inverted at the very top. There have been countries that tried to actually change this structure. 2 experiments, 2 different outcomes. 1994, Estonia, just 3 years out of the Soviet Union. The economy was on the verge of collapse. Prime Minister Mart Laar abolished the complex progressive system and introduced a flat rate of 26% for everyone. The tax code was radically simplified. Rates went down, yet more tax was collected. The shadow economy came into the light. Foreign capital flooded in. Estonia ranked first in the OECD Tax Competitiveness Index for multiple consecutive years. Simplification created transparency. When the complex tax code disappeared, the room to build leather wallets shrank too. But in 2024, Estonia was forced to revise this philosophy. The Russia-Ukraine war demanded a rapid surge in defense spending, and aging demographics sent welfare costs soaring. Under a flat-rate structure, there was no flexibility to levy additional charges on the wealthy in a crisis. Even a tax system that had maximized efficiency reached its limits when confronted with the state's foundational duties: redistribution and emergency reserves. On the other side stands New Zealand. This country had no comprehensive capital gains tax. The top income tax rate for workers, 39%. Capital gains tax for property owners, 0%. The result was the worst housing bubble in the nation's history. In 2019, Prime Minister Jacinda Ardern's government pushed for a comprehensive capital gains tax. The design was economically sound, but it was killed by a single veto from a coalition partner. Ardern declared she would never again pursue a capital gains tax within her political lifetime. Estonia showed that simplification is possible. New Zealand showed that even the right design can be stopped by politics. Together, the two countries prove one thing: taxation is not a question of tax rates. It is a question of power distribution. The power that blocks the right design is power. The power that makes you abandon simplification is power too. Then, is there a direction? There is. First, tax earned income and capital income by the same standard. Denmark already does this. Capital gains are taxed at 42%. Denmark's economy has not collapsed. Second, simplify the tax code to reduce the infrastructure of tax avoidance itself. The more complex the tax law, the more opportunity to build leather wallets. As Estonia demonstrated, reducing complexity creates transparency. Third, apply withholding to capital income as well. Financial data is already tracked in real time. The reason withholding applies only to wage earners is not a technical limitation. It is a political choice. The leather wallet can be made of glass too. The decision simply hasn't been made. Professor Gabriel Zuckman discovered that when national asset and liability data across the world were added up, trillions of dollars belonged to no one. The number that looks as if aliens own the Earth's debts, that is the true scale hidden inside the leather wallet. Profits shifted annually to tax havens like Bermuda and the Cayman Islands by multinational corporations. $1 trillion. Personal financial assets hidden in offshore secret accounts. $12 trillion. Tax just 2% on the wealth of 3,000 billionaires, and you generate $250 billion in additional revenue per year. That equals the entire climate change adaptation budget of the developing world. The money's location is known. It simply isn't being caught. The current tax system collects first from where it is easiest to collect, not from where it is most equitable. Wage earners were not the biggest payers of tax. They were simply the most visible wallets. This system was not a deliberate conspiracy. It was an administrative fix born of wartime urgency that calcified into permanence. And atop that, decades of lobbying were stacked layer by layer. But the result is the same. Some wallets were glass from the start. Others were leather from the start. Today, too, the tax is taken before the paycheck arrives. Your money is taxed the moment it is seen. Their money delays even the moment of being caught. 1943. War made the wage earner's wallet glass. That glass has not shattered yet. The real question is this: was what we believed to be fair truly fair, or were we simply the wallets that were caught first?